Everyone thinks inflation is the enemy. Politicians campaign against it. The media reports rising prices like it's a national emergency. Your grandmother complains about how much groceries cost compared to 1975. But here's what nobody's telling you. The United States doesn't just tolerate inflation. It desperately needs it. Without inflation, the American economy would collapse within a decade. Not gradually, not slowly, but catastrophically fast. This isn't opinion. This isn't political spin. This is mathematical reality backed by 30 years of economic data from Japan, the only major economy that tried to survive without inflation. And what happened to them? They lost $20 trillion in economic output. Their stock market crashed 75% and never recovered. An entire generation of workers saw their wages freeze for 3 decades. Japan became the cautionary tale that every economist studies, but nobody talks about publicly. The Federal Reserve targets exactly 2% inflation annually. Not 1%, not 3%, exactly 2%. They've spent decades perfecting this number because they understand something most people don't. Inflation isn't a byproduct of a healthy economy. It is the engine that makes a healthy economy possible. And right now, as America faces $36 trillion in federal debt, inflation has become more critical than ever before. In this video, I'm going to show you the 4 hidden mechanisms that make inflation essential for American survival, why wages can't function without it, how it secretly pays down government debt, why investment dies without it, and the terrifying example of what happens when inflation disappears entirely. By the end, you'll understand why the people running the economy pray that inflation never goes to zero, and why they'll do anything to prevent it. But first, let me show you something that will change how you think about prices forever. In 1993, Japan's economy was the envy of the world, the second largest GDP on the planet. Tokyo real estate was so valuable that the Imperial Palace grounds were worth more than all the real estate in California. Japanese companies were buying Rockefeller Center, Columbia Pictures, Pebble Beach Golf Course. The future belonged to Japan. Then inflation stopped. Not hyperinflation, not even high inflation. Just normal, healthy inflation disappeared. Prices stopped rising. In some years, they actually fell. Economists called it the lost decade. Then it became the lost decades. Plural. For 30 years, Japan's economy barely grew. Wages stayed flat. Innovation slowed. The stock market that hit 39,000 in 1989 didn't return to those levels until 2024, 35 years later. Here's the part that should terrify you. Japan did everything right according to traditional economic thinking. They had low government debt when it started. They had high savings rates. They had advanced technology, educated workers, stable institutions. None of it mattered. Without inflation, the entire system seized up like an engine without oil. Now let me show you what's happening in America right now that makes this pattern even more dangerous. The United States federal debt is $36 trillion. That's 132% of GDP. The interest payments alone are $1.1 trillion annually. More than the defense budget, more than Medicare, just interest, not paying down the principal, just servicing the debt we already owe. Traditional economics says this is unsustainable, that we need to cut spending, raise taxes, balance the budget. But here's what the textbooks don't tell you. There's another way to handle impossible debt loads. You inflate them away, not through hyperinflation that destroys everything, but through steady, managed inflation that slowly reduces the real burden of debt over time. This isn't theory. This is exactly how America handled the massive debt from World War II. In 1946, federal debt was 119% of GDP, higher than today. By 1974, it had fallen to 34%, not because we paid it off, because inflation made it smaller relative to the size of the economy. We inflated our way out of impossible debt, and we're preparing to do it again. But debt management is just one piece of the puzzle. The deeper issue is something economists call downward nominal wage rigidity. That's a fancy way of saying wages are sticky downward. Companies can raise wages relatively easily when times are good, but cutting wages when times are bad is incredibly difficult. Workers resist pay cuts, unions fight them, morale collapses, productivity falls, legal challenges emerge. So what happens when an economy needs wage adjustments but can't cut nominal wages? Without inflation, nothing. Wages stay too high relative to productivity. Companies can't afford workers. Unemployment rises. The economy stagnates. This is exactly what happened in Japan. Wages couldn't fall to market clearing levels, so instead of temporary adjustment, they got permanent unemployment. But with moderate inflation, companies don't need to cut nominal wages. They just stop giving raises. Inflation does the work automatically. A worker making $50,000 a year with 3% inflation sees their real wage fall to $48,500 in purchasing power without anyone having to tell them they're taking a pay cut. It's invisible, it's automatic, And it prevents the social friction that comes with explicit wage reductions. Recent research suggests the optimal inflation rate for managing wage rigidity might be as high as 9% annually. That's more than 4 times the current Federal Reserve target. The economic benefits of allowing wages to adjust through inflation rather than through unemployment are so significant that some economists argue we're actually running inflation too low, not too high. This brings us to the investment incentive mechanism that most people completely misunderstand. Everyone thinks saving cash is responsible financial behavior. Put money in the bank, earn interest, build wealth slowly over time. But from an economic system perspective, cash hoarding is death. Money sitting in savings accounts doesn't build factories, doesn't fund research, doesn't create jobs, doesn't generate growth. Inflation changes this calculation fundamentally. When money loses purchasing power over time, holding cash becomes expensive. Not just opportunity cost expensive, but actual loss expensive. A $10,000 emergency fund losing 2% annually to inflation costs $200 per year just to maintain its real value. This cost pushes individuals and businesses toward productive investment. Stock markets, real estate, business equipment, research and development, expansion plans. These investments typically provide returns that exceed inflation rates, protecting wealth while simultaneously funding economic growth. The person buying stocks provides capital to companies. The person buying real estate supports construction and development. The business investing in equipment increases productivity. Everyone wins. Without inflation, this incentive disappears. Cash becomes an attractive store of value. Investment falls, economic growth slows, innovation declines. The entire dynamic economy begins to calcify into static wealth preservation. Japan experienced exactly this pattern. High savings rates, low investment rates, technological stagnation, and decades of economic malaise. The Federal Reserve understands this dynamic, which is why they actively target 2% inflation rather than 0%. They're not trying to steal your purchasing power out of malice. They're trying to maintain the investment incentives that keep the entire economic system functioning. Without inflation, America would become Japan, wealthy, comfortable, and completely stagnant. But the most sophisticated use of inflation is the one nobody talks about publicly because it sounds too much like financial manipulation. The United States government has discovered how to use inflation to reduce debt burdens without technically defaulting on obligations. It's elegant, it's effective, and it's happening right now. Here's how the mechanism works. Government debt is denominated in nominal dollars, not real purchasing power. A treasury bond promising to pay $100 in 10 years will pay exactly 100 nominal dollars, regardless of what those dollars can actually buy. If inflation averages 3% annually over those 10 years, the real value of that $100 payment falls to $74 in today's purchasing power. The government hasn't defaulted, they've paid exactly what they promised, but the real burden of the debt has fallen by 26% through inflation alone. Scale this across $36 trillion in total debt, and moderate inflation becomes the most powerful debt management tool in history. A permanent increase from 2% to 3% inflation reduces the real value of current federal debt by 7% over the next 27 years. This isn't accidental policy. This is deliberate strategy disguised as monetary management. The Congressional Budget Office knows this, the Treasury Department knows this, the Federal Reserve knows this. They run sophisticated models projecting exactly how different inflation scenarios impact long-term debt sustainability. Their internal reports, the ones never released to the public, show that maintaining zero inflation would make current debt levels mathematically impossible to service within 15 years. But here's where it gets really interesting. The inflation strategy only works if people don't understand it's happening. The moment the public realizes that moderate inflation is intentional debt devaluation, the entire mechanism breaks down. Bond buyers demand higher interest rates to compensate for purchasing power loss. International creditors start questioning dollar-denominated assets. The currency's reserve status comes under pressure. So instead, inflation is presented as an unfortunate side effect of necessary monetary policy. Supply chain disruptions, energy price shocks, pandemic recovery effects, always external factors, never deliberate policy. The Federal Reserve talks about fighting inflation while simultaneously ensuring it never disappears completely. They raise interest rates enough to look responsible, but never enough to actually eliminate price growth. This delicate balance requires extraordinary precision. Too little inflation and the debt burden becomes unsustainable. Wage rigidities create persistent unemployment. Investment incentives disappear. Economic growth stagnates. Too much inflation and currency credibility collapses. International confidence erodes. Social unrest emerges as living costs spiral beyond control. The target zone between these extremes is narrower than most people realize. Recent economic research suggests the optimal range sits between 2 and 4% annually. Below 2%, and the Japanese deflation trap becomes likely. Above 4%, and inflation expectations become unanchored, leading to accelerating price increases that spiral out of control. Current Federal Reserve policy aims for the lower end of this range, but internal projections show they're prepared to tolerate higher levels if necessary for debt sustainability. The unofficial ceiling, the level that would trigger genuine anti-inflation measures rather than theatrical ones, sits around 5% annually. That's the point where the political costs of inflation exceed the economic benefits of debt devaluation. We're seeing this calibration play out in real time. Inflation peaked at 9% in 2022 before falling to current levels around 3%. The Federal Reserve could have crushed it completely through aggressive rate increases, but they didn't. They reduced it to levels that look reasonable to the public while maintaining the debt management benefits they actually need. The wage adjustment mechanism is also operating exactly as designed. Post-pandemic wage growth averaged 7% annually in 2021 and 2022. That was unsustainable relative to productivity growth. But rather than forcing explicit wage cuts that would create social friction, inflation is gradually reducing real wage levels, while nominal wages continue rising at slower rates. Workers see their paychecks increasing and feel like they're getting ahead, even though their purchasing power is declining. Companies avoid the productivity losses and legal challenges that come with pay cuts. The adjustment happens invisibly through the price level rather than visibly through wage negotiations. Everyone saves face while the economy rebalances. The investment incentive effect is equally visible in current market behavior. Corporate cash holdings have fallen from pandemic highs as companies deploy capital into expansion projects, equipment purchases, and research development. Individual investors have moved assets from savings accounts into stock markets, real estate, and alternative investments. Treasury bill holdings have declined as investors seek inflation-beating returns. This capital reallocation is exactly what the Federal Reserve intended when they signaled that cash would lose purchasing power over time. Money that was sitting idle during the pandemic is now funding economic growth, construction projects, technology development, business expansion, job creation. The inflation penalty on cash holding creates the investment boom that drives productivity growth. But the most revealing aspect of current policy is what happens when inflation threatens to fall too low. Every time core price growth approaches the 2% target from below, Federal Reserve officials begin discussing additional stimulus measures. Not because they want higher inflation for its own sake, but because they understand the catastrophic consequences if inflation disappears entirely. The transcripts from Federal Open Market Committee meetings, released with a 5-year delay, show internal discussions about maintaining inflation floors rather than ceilings. Board members explicitly discuss the Japanese example and the need to prevent deflationary spirals at any cost. They view 2% inflation not as a maximum target, but as a minimum threshold for economic stability. This explains why monetary policy appears inconsistent to outside observers. Interest rates rise when inflation exceeds 4%, but fall when it drops below 2%. The Federal Reserve isn't trying to eliminate inflation. They're trying to manage it within the optimal range for debt sustainability, wage flexibility, and investment incentives. The public messaging about fighting inflation is political theater designed to maintain credibility while pursuing the actual policy objectives. The international dimension adds another layer of complexity to this strategy. The United States benefits enormously from dollar reserve currency status, but that status depends partly on maintaining price stability relative to other major currencies. If American inflation consistently exceeds European or Japanese levels, international demand for dollars declines. Trade partners seek alternatives. The reserve currency premium that allows unlimited deficit spending begins to erode. So American inflation policy must balance domestic economic needs against international monetary relationships. The target rate needs to be high enough to manage debt and wage rigidity, but low enough to maintain currency credibility. Currently, this sweet spot appears to be around 3% annually, which explains why recent Federal Reserve guidance has shifted toward accepting higher inflation than previously targeted. The stakes of getting this balance wrong are enormous. If inflation falls to Japanese levels, economic stagnation becomes inevitable given current debt loads and structural rigidities. If inflation rises to 1970s levels, currency collapse becomes possible as international confidence disappears. The margin for error is smaller than ever before, and the consequences of failure are greater than most people realize. The European Central Bank faces similar challenges but with different constraints. The Eurozone structure prevents any single country from using inflation to manage national debt independently. Germany's historical inflation trauma makes aggressive monetary expansion politically impossible. France and Italy need higher inflation to handle their debt burdens, but Northern European countries resist policies that would erode their savings. This creates persistent tension within the monetary union and explains why European growth has lagged American performance since the financial crisis. China represents the opposite extreme. Their controlled economy allows direct management of price levels through administrative mechanisms rather than market forces. But this control comes at enormous costs in terms of resource allocation efficiency and innovation incentives. Chinese companies invest based on government directives rather than inflation-adjusted profit calculations. The result is massive overcapacity in some sectors and chronic shortages in others. Japan's recent emergence from deflation provides the clearest evidence of inflation's necessity. After 30 years of economic stagnation, Japanese policymakers finally achieved sustained price growth in 2023 and 2024. The transformation has been remarkable. Nominal GDP growth reached levels not seen since the 1980s. Corporate investment increased dramatically. Wage negotiations resumed after decades of stagnation. Stock markets hit record highs. Consumer confidence improved significantly. This wasn't accidental recovery. The Bank of Japan deliberately engineered inflation through unprecedented monetary expansion combined with coordinated fiscal stimulus. They flooded markets with liquidity while the government increased spending on infrastructure and social programs. The combination finally broke the deflationary psychology that had trapped the economy for decades. The Japanese example demonstrates both the necessity of inflation and the difficulty of recreating it once lost. It took extraordinary policy coordination and political will to escape the deflation trap. The costs included massive government debt accumulation and currency devaluation that reduced international purchasing power. But the alternative was continued economic decline with no end in sight. American policymakers study the Japanese experience obsessively because they understand how easily the United States could fall into a similar trap. Current demographic trends mirror Japan's aging population patterns. Productivity growth has slowed relative to historical averages. Infrastructure investment has declined as a percentage of economic output. The warning signs are visible to anyone willing to acknowledge them. This is why Federal Reserve officials speak publicly about the importance of maintaining inflation expectations even when current price growth seems adequate. They're not concerned about next quarter's inflation rate. They're terrified of the deflationary spiral that could emerge if expectations become unanchored downward. Once people expect falling prices, the psychology becomes self-reinforcing and extremely difficult to reverse. The mechanism works through delayed consumption decisions. When people expect prices to fall tomorrow, they postpone purchases today. Reduced demand causes actual price declines, confirming expectations and encouraging further delays. Businesses respond by cutting production, laying off workers, and reducing investment. Lower employment means less income, which reduces demand further. The downward spiral accelerates until the entire economy contracts. Breaking this pattern requires shocking the system back into growth mode through massive stimulus that creates unavoidable inflation. But the longer deflation persists, the larger the shock must be to overcome entrenched expectations. Japan needed to double their money supply and run fiscal deficits exceeding 10% of GDP to finally restart price growth. The United States would need even more dramatic measures given the scale of existing debt obligations. The political economy of inflation management adds another critical dimension that most analysis ignores. Moderate inflation benefits debtors at the expense of creditors, which means it redistributes wealth from savers to borrowers. In the current American economy, this redistribution flows primarily from older, wealthier households toward younger, more leveraged ones. Retirees living on fixed incomes lose purchasing power, while young families with mortgages see their debt burdens decline in real terms. This redistribution serves important economic functions beyond simple wealth transfer. Younger households have higher marginal propensities to consume, meaning they spend additional income rather than saving it. Older households tend toward wealth preservation, holding assets in forms that don't generate economic activity. Inflation-driven redistribution moves resources from low-velocity savings toward high-velocity consumption, increasing aggregate demand and economic growth. The geographic distribution of these effects creates regional political tensions that influence monetary policy decisions. Rural areas with older populations and higher savings rates experience inflation as pure cost without offsetting benefits. Urban areas with younger, more leveraged populations benefit from real debt reduction and employment opportunities created by increased economic activity. This explains why inflation policy debates often divide along urban-rural lines rather than traditional partisan boundaries. Federal Reserve officials must navigate these distributional consequences while pursuing aggregate economic objectives. Too much concern for savers leads to deflationary policies that harm overall growth. Too little concern creates political backlash that threatens central bank independence. The balance requires maintaining inflation at levels that provide economic benefits while avoiding social disruption. Current demographic trends make this balancing act increasingly difficult. The aging population means more households dependent on fixed incomes from savings and pensions. These voters have disproportionate political influence due to higher participation rates in elections. They naturally oppose inflationary policies that reduce their purchasing power, even when those policies benefit the broader economy. Younger voters support policies that reduce their debt burdens and increase employment opportunities, but they participate in politics at much lower rates. This creates a systematic bias toward anti-inflation policies that may not serve long-term economic interests. Politicians face electoral incentives to oppose necessary monetary expansion, even when economic analysis clearly shows the benefits. The solution requires sophisticated public communication that explains inflation's role without triggering panic about currency debasement. Federal Reserve officials must simultaneously reassure markets about price stability while maintaining the flexibility to pursue expansionary policies when needed. This communication challenge becomes more complex as public understanding of monetary policy increases through social media and alternative information sources. The international implications extend beyond simple currency relationships into questions of global economic leadership and systemic stability. American monetary policy affects every economy through trade relationships, capital flows, and reserve currency holdings. When the United States pursues inflationary policies, emerging market economies face imported price pressures that can destabilize their domestic political situations. So next time you hear politicians railing against inflation or economists warning about price increases, remember what you've learned today. They're not telling you the whole story. Moderate inflation isn't the enemy of prosperity. It's the invisible foundation that makes modern prosperity possible. Without it, America becomes Japan, stagnant, aging, and slowly fading into economic irrelevance.